Hello, everyone, and welcome to this session of TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. We have an exciting session ahead of us and looking forward to getting started. As always, we have to go through some important housekeeping details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website to be read in full detail there, or feel free to take a screenshot of it if you like, but that's the main point to take away. Now, for this session, we are live streaming to multiple different platforms. So after Rob does his general presentation and then goes through some case study considerations, we'll open it up to a few questions with the time remaining. So given that we are live streaming to multiple platforms, we'll try to get some questions from each of those platforms. Just know that if we don't get to your question, it has nothing to do with the validity. We just only have so much time. So with that, take it as encouragement to attend the insiders meeting when there's a 45-minute session solely for the portion of answering questions for subscribers. So obviously a much higher likelihood of getting your question addressed there. We have the chat window as well. So for any interaction amongst other attendees, please feel encouraged to use that window. Just note that by default, it changes to host and panelists. So be sure to change that to everyone if you would like everyone on the webinar to see your call or to see your message. So yeah, I got to ask, are the meme stocks back? I'd be interested to hear Rob's thoughts on that, as well as also with the action with Bed Bath & Beyond. So as always, interested to hear your question and comments from everyone that's watching on the multiple platforms, and of course to hear Rob's insight. So at this point, I will get out of the way and introduce who we're all here for. That's Rob Roy.
Thanks, Zach. Hi, everybody. Welcome to this week's TradeFinder Live. If you haven't been here with us before, give you a brief rundown of how things work. There's the video, so I can see my ugly mug as we go through the presentation. We'll talk about the markets, not just our market, but the international markets as well. We'll go through any closed trade alerts that we have done for our Elliott Wave Option Trade Alert subscribers, give you an idea of how that works. Look for case study considerations for this week, as well as a review of those that we've looked at in previous trade finders. And then, as Zach went over at the end, open it up for a live Q&A. Boy, pretty interesting. Zach previewed it with the meme stocks is the meme phenomenon back. Well, let's take a look at the markets first. We'll get there. And there's lots to discuss along those lines. For me, it has to do with liquidity, as we talked about in the U.S. market update both the past 2 weeks. The fact that the Federal Reserve had said they were going to start withdrawing liquidity in June. They didn't do it. They were going to withdraw $47.5 billion. They withdrew one, and the numbers aren't out from the Federal Reserve as far as what they've done for July yet. As soon as they are, we will let you know. But I think we can pretty much guess. Hasn't been a lot of balance sheet reduction in this month either. All you have to do is look at that mean phenomenon again, as well as what's occurred in the markets. You can see this move to the upside. There is some short covering going on. We talked about if we could get above 420, there'd be some short covering. The whole FOMO, there's the fear of missing out. And then there's the fear of, I'm short, and the market's going to the upside. So it's kind of a double-edged sword there. But when you look at the volume, it's still not there. I've mentioned this numerous times. The move cannot last without volume. I felt like if we got above 420 and the short covering started to come in, that could get us to average or above average volume. Even that hasn't gotten us there. And so I just want to be really clear on this. When I say that the move can't last, you can see we're clearly moving to the upside. We're starting to go a touch vertical, which would be a little bit concerning if you're along the market. But if we don't get some volume like really soon, the move won't hold. So what I mean by that is we will retrace back down. That doesn't mean we're going to go make new lows, even though we still have a qualified 5-wave impulse pattern to the downside. You can see the wave 4 is just right now at that all-important 61.8% fib level, the strongest fib level. So on the high, we got just above it. And so if we looked at the closing price, I'd say we're probably dead on 61.8. You look at the moving averages, you can see we're a tiny bit overbought, not that significant. So that's not really a concern. But this is where the rubber meets the road. So this is it. Last bastion of support. We had a 50% correction that held here right underneath the 420 level. We were able to get above that. So we've moved higher. We never filled this gap, or at least haven't yet, between the 9th and 10th of August. So that gap's still sitting out there, and a little bit vertical, not significant, but volume has got to come in at some point. Walmart helped the market today with their numbers. And so the whole retail sector, anything retail, moved to the upside today, it seemed like. But I still stand by the fact that it doesn't matter if we go higher from here. Even if we break above 61.8, we could make it up to 440 because there's some more resistance there. There's not really, other than this fib level, a whole lot in the way of where we were today, the highs of the day, up to 440, other than the 61.8% fib level. So we could go a little bit higher here, and then we'll find out more as we get to that resistance area. So we have this area right here at 420. We got above that. The next area of resistance is 440, and we'll see if we can break above that. I'll look at the VIX in a minute, but I wanted to look at interest rates, and you can see nothing's really happening with rates. And that begs the question of, well, if the Federal Reserve isn't withdrawing liquidity, are they actually adding liquidity? We'll find out when we see the numbers, but at least it appears they're leaving the liquidity in, and leaving the liquidity in gives room for the markets to move back to the upside. So if you've got all that money that they put in and they haven't really taken any of it out, because the rate hikes haven't affected the market yet. It's important to remember that. It takes about 6 months before a rate hike works its way through the economy. So we're going to see some of it in the next earnings cycle, but really in the following cycle. And then you start to wonder, are they playing politics? I know a lot of you made comments about that on the last YouTube video. If you haven't visited our YouTube, for those of you live streaming, welcome. If you're on YouTube and haven't been to our webpage, please do so. You can take a look at the last recording there on our webpage at Elliott Wave Options. But are they playing politics? Maybe. If there's two sides to it, in my opinion. One, leaving this liquidity in with the rate hikes moving up may mean they don't want to collapse the market going into an election. And raising rates at the rate that they are, we're back up to a 75 basis point. I mean, it's been moving between 75 and 50 at the next meeting. We're back up to the Fed funds futures forecasting 75 basis points again. With the excess liquidity, it could be that they feel like if they give that double whammy, that was the title. And some of you were questioning, what does a double whammy mean? That means raising rates and withdrawing liquidity. Try that again. Withdrawing liquidity at the same time. I just can't see a scenario for the markets to go much higher from here if they're doing that. That's a big if. If they're not, that's a whole different scenario. And we could go higher from here. If all that excess liquidity that they pumped in, they're going to leave here, and then we've got a few more months before all these rate hikes start to really affect the economy, that's a little bit of a cushion for the markets to move higher. And so we'll wait and see. Giving the Fed a little more credit could be the fact that, all right, they're having to raise rates faster than they thought to try to tackle this inflation. So they don't want to give the double whammy to the market. It has nothing to do with politics. They're just trying to ease into this reduction of inflation and keeping a bit of liquidity so that we don't have this big crash in the markets. And that's their only goal, is they're trying to manage this the best way they can without creating a big move lower and havoc. So as I said, that's giving the Fed a bit more credit than I normally do. The conspiracy theorists can certainly look at, they're doing this because the election's coming up and they don't want to influence the election. Both of those things make sense and they're valid points, but the bottom line is they're not withdrawing liquidity at the rate they said they were going to. They're raising rates faster than they thought they would have to. That hasn't affected things yet. So basically, it's okay. We had this big move lower in the market because we thought they're going to be raising rates and withdrawing liquidity. They haven't done that. So the liquidity is still there. The raising rates hasn't hit the market yet. Where do you think the market's going to go? Path of least resistance back to the upside. That's what's been going on. So that's the important thing to remember if you're wondering, because I know a lot of you are like, this makes no sense. And there were a lot of comments like that. The market often does things that make no sense, no common sense, but that's what's occurring. The liquidity is still there. The rate hikes haven't hit the market yet. So it's all of a sudden like, okay, well, we didn't need this big sell-off. And in my opinion, knowing that, because remember, I've mentioned this numerous times, shorts are really smart. And they're really smart because they take the most risk in the market. Aside from options, derivatives, anything else, short sellers take the most risk. And they've backed away. They just have literally backed away. And that's why we have such low volume. There isn't any short pressing going on. If you watch the intraday moves, anytime the market ticks down, it's bought into. It's a buy the dip mentality right now. And that's only working because the shorts haven't press things. It's also leaving room for the meme phenomenon to come back. Where did that come from? Excess liquidity. That's why we had the whole meme thing. And so now you have some, kind of cagey hedge funds that are getting involved again. I know that a lot of retail traders think they're strong enough to create short covering. They're not. They have to have some participation from hedge funds to do it. And that's what's occurring again. So let's take a look at the dollar real quick. Not a whole lot to talk about. Came down, bounced up a bit. Not much going on. The dollar's kind of staying status quo. Again, telling you nothing is really happening. It's kind of a status quo, if you will. Rate hikes going up, no liquidity being pulled out. Where's the dollar go? Sideways. That makes a lot of sense. So Zach mentioned Bed Bath & Beyond in the intro. Take a look at that. If you're wondering why we were saying, hey, are the meme stocks back? Look at that move. All because one of the heads of Bed Bath & Beyond bought a whole bunch of way out of the money calls. He bought calls all the way up at 60 and 80. Why would you buy 60 strike calls when the stock's trading down here at 10 or 15? What did he know? That's when you start to get some real conspiracy theories on Was there some chat with a hedge fund? Because think about what happened with AMC. AMC was going out of business. BBY was on the verge of going out of business. But if you can get this kind of a move and they sell into it and they're able to shore up their balance sheet based on the movement of the stock price, it allows them to stay in business. Bed Bath & Beyond was in real trouble if you looked at their earnings statement and their balance sheets, etc. And so they fired the CEO, they brought in a new CEO, and then look what's happened. So it certainly makes you think, especially when you see that kind of volume. Double the float was traded today. Double every single share that's available. Twice the amount of every single share that is available on Bed Bath & Beyond traded twice today. Who has that power? Not the retail traders. I'm sorry, Reddit and Wall Street Bets, you all don't have that much power to create that kind of volume. You don't. There's a hedge fund in there dealing with this. And you got to be really careful if you're going to play in this, because look, the high was up at 28. What the high was 28.60. We closed at 20. So if you got sucked in around 25, you had a bad day. But if you were in down here at 10, you're loving this. It's a really dangerous game to get involved in this, and it's not being controlled by retail traders. There's a hedge fund in there, or more than one, in cahoots that are doing this. And perhaps the selling came in from the company themselves, the executives, whatever, trying to shore up their balance sheet. I don't know that. That's speculation on my part. I'm just saying that did happen with AMC and GameStop. Both of them did the same thing. GameStop was smarter, but AMC did it. No, it was the other way around. AMC was smarter, and then GameStop finally figured it out after they fired their CEO. The next CEO came in and did the exact same thing. And you can see this move to the upside on GameStop, and everybody's talking the stock up like all of a sudden it's the golden child of the market. They're still struggling, but their balance sheet is in good shape now. Why? Because of all this craziness that occurred back here, and they were able to bring in some money, and now the company doesn't have financial difficulty anymore. Same thing with AMC back here when you had this big move to the upside. They got in time to where they were able to bring in some liquidity, shore up the balance sheet a little bit, and survive a bit longer. We'll see years down the road if they get back into the same boat again, but for now, they're okay. Is Bed Bath & Beyond following suit with GameStop and AMC? Very well could be. And you can't blame them if they are. If they have that opportunity, you got to do whatever you can to save your business. And if that's what they're doing, then, I mean, I don't really fault them for that. I just want to encourage you, our viewers, to be really careful getting involved in that mess. Yes, you can get lucky and have a big payday, but you can also get on the other side of it and get crushed. So it's risk reward. If it's play money that you don't need, that doesn't pay your bills, hey, take a shot at it. Who knows? But if it's money that you're trading that you need to pay your rent or pay your light bill or whatever, that is not money you should be playing in this game. That's my opinion. That's my fatherly advice for whatever. And I know all you young people won't listen to me anyway, because kids never listen to their parents anyway. But that's just one of the things that I wanted to share with the whole meme phenomenon. All right, so let's go ahead and take a look at a closed alert that we had for our alert subscribers. This is at Elliott Wave Options. We look at case study considerations in TradeFinder for those of you that may be new. The difference is our alert subscribers pay a subscription, and we send them out an alert email and text, or either one if it is a preference, on an entry, any adjustments, and the exit. With TradeFinder, we'll look for a case study consideration, then you're on your own. But we have a whole bunch of them that we do for our alert subscribers. And this one was on HEAR. This was in our AI-based time strategy. So some of you may have seen some of the commentary in our past recordings about this new AI-based strategy. It's designed for stocks that are staying in a trading range following a big drop. It's exactly what happened with HEAR. There you can see there was the move to the downside that occurred following its earnings report. And with the VIX coming down, we're finding a lot of new setups, a lot of new entries. And at the time that this alert was sent out, the spread was 15 cents. We sent out the alert at 20 cents and we got filled at 25. So the market makers started to figure it out. But the exciting thing about this is with the VIX lower now, you're going to see more mispriced options. When the VIX was so high, everything was overpriced. But now with the VIX lower, you'll see some of those inequities in the pricing, and we can take advantage of that. So it's super exciting. If you've been watching any of these recordings and you've heard about this and you've considered becoming an alert subscriber, no better time now. Our level 1 is the AI-based time strategy. Love to have you. It would be a perfect opportunity for you to come in, kick the tires. We don't require any money or any contracts up front. It's a month-by-month thing. So you can try it for a month, see if you like it, and move on from there. So you can see 4 days later on our exit, the exit alert we sent out was for 50 cents. So that was the alert that we sent out. That was where the midpoint was at the time it was sent out. The spreads had come in. They didn't want to fill that. So that was sitting there. So I sent out a comment to our subscribers that said, hey, you might want to consider on this one putting in a good to cancel order and be patient. Let it sit for a couple days if needed. Well, towards the end of the day today, it moved to 45 cents. And so we took it. So if you have your order out there, 45 cents should get filled. If not, we talk about brokers, etc. There's no reason 45 cents shouldn't get filled. The spreads are really tight. It's a September-October calendar spread. That should get filled. So how about an 80% return in 4 days on a trade that's expected for the stock to go sideways? What we took advantage of was a volatility spike on that big drop in the pricing. So those are back. Volatility skews have returned, and little bit of time decay, not much, because it was September option. It wasn't even October, or excuse me, wasn't even August. So that shows you the possibilities that are out there. We're super excited about this strategy moving forward for our alert subscribers, where we're going to be towards the end of the year. The track record is phenomenal already with this. So anyway, wanted to share that with you, and you can contact support if you have questions regarding becoming a subscriber. No better time, I said, than where we are right now. Looking at some of our past case study considerations that we've had here on TradeFinder, there's only a handful of them left that wouldn't have been considered closed out. We can see that we have Reliance Steel. That's where we were. It's moved back to the upside here, and we have adjusted this for our alert subscribers because we did send this out as an alert. We adjusted it to a downside trade, but that's assuming that it holds 200. So it has to hold 200. It's a bit overbought now, so it's likely going to hold it the next couple of days. But if it breaks above 200, then we will adjust back to the upside here and see how that plays out. On HZO, we started here. We adjusted this one into a strangle. It broke to the downside. We took the puts off and we added to the calls, and look what's happened since then. So we had the downside break. We had the big move back to the upside. Banner day for HZO today because we took the puts off on the move downward and then added to the call side on the way back higher. So not sure what you all might have been doing with this one when we first looked at it, but that's what we did. And as I said, today was a great day for HZO. Looking at Mosaic, and you may have heard as fertilizer plants struggling to be open in the Ukraine, shutting down in China. You just feel like at some point in time, this is just a move to the downside, significantly waiting to happen. So we've adjusted this to the downside. You can see we had a 50% bounce in the wave 4. We broke down yesterday, filled that gap today. And with this 50% wave 4 at a bit of resistance here, it's hard to imagine any sort of a bullish scenario for anything related in that realm of things. So expectation is for that one to continue lower. All right, so 2 weeks ago, we looked at LHX. So this was L3 Harris, and we said if it held one, what do we write here? Oh, once the overbought condition is rectified. So that occurred the next day. So go back here. There's where we were. You can see we're up here in the 10-day moving average down here around 235. So it said once that was rectified, you could get in. So once we hit that, so your entry should have been somewhere in this area once we close that 10-day moving average. And so that would be around 235. And we moved a bit lower than that, and we closed at 239. So you should be up if you're following this one and follow the guidelines. You should be profitable, but let's hang on to that one and see if we can't break out of this resistance at 240 and get a bit of a more sophisticated move to more substantial move to the upside. And, you know, with all the rhetoric that's going on between China and Taiwan, China's really mad at us for sending all our elected officials over there. We keep doing it. So we're just stirring the pot. I don't know that China's someone you want to stir the pot with. We'll see how it plays out. But, you know, China dealing with the China stocks is a dangerous game right now with the unknown about whether or not they would actually advance into a stage of war. And then last week, this is the one that I said if it would hold. Last week, we looked at AJG and we said if it holds 180, so the next day, yeah, it never even came close to 180. So somewhere in there you should have entered if you were going to follow that one. And now we're all the way above 190. So about a 6-point gain at the minimum that you should have had on this one. So a really nice profit there. You take a look at the DMI, we're starting to get a bit overbought. So you can hang in there. Note that when the ADX gets like this, it doesn't mean the entire upward move is over, but it does mean the strongest part of the move is over. We'll see if we can move it up towards 197 before the move ends, but I would tighten stops or whatever your mental stops if you're looking at this one and see how the next day or two go and maybe go ahead and take the gain there. But that was last week and that worked out really well. So hopefully all of y'all have been following the last couple of weeks. If so, then you've been very happy. And you know, we did the MTH, et cetera. We've just had a pretty good run here on these case study considerations. All right, so let's take a look at some more markets and then we'll see if we can find a case study consideration for tonight. So looking at the Dow, we bring that market in, and I'll look at the VIX after we look at the Dow. But you can see with the Dow, pretty good day today because of Walmart. And so look at the moving averages, tiny bit overbought, not that significant. Now, the thing to look at here is 68%. We're getting in the area of where this 5-wave impulse pattern would become disqualified. Moving above 340 today was a big deal. But, you know, you have to have a second day, a follow through, a confirmation day. You've heard me say that how many times? Look at the volume, though. A little better volume, still not average, but a little better volume on the Dow than we had on the SPY. Then again, probably short covering. I know a lot of people were very surprised about the numbers that Walmart put up. They thought it was going to be much worse than that. And so pretty decent move to the upside there. But can we follow through on that move tomorrow? That will be the key on the Dow. I wanted to show you the VIX here before we go into any of the further markets. And we're all the way back down here. And you can see that we're hovering right in that 20 area, which has been support, tried to break below it. If we hold 20, then a bounce back to the VIX would likely mean a rollover in the markets. So if you're long the markets, you want to see this 20 level broken. You want to move down towards 18, kind of fooling around in there for a while, which would give some ammunition for a move back higher. But you don't want to see it bounce off of 20. And the longer we sit on top of this, the greater chance there is that the VIX bounces from here. So let's be careful there. And then the Qs, we'll take a look at those. Doji today. Look at that. Almost an absolute perfect doji, opening at 332.06, closed at 332.28. That's about as nice of a doji as you're going to get. So that means indecision. Remember, that doesn't necessarily mean change of direction. A lot of people tell you a doji means change direction. Not by definition. By definition, it means indecision. Now, because of that indecision, oftentimes you do get a change of direction, but it's not the doji that's telling you you're going to have a change of direction. The doji is telling you there's indecision. And so you take a look at what happens there and make your decision along those lines. So let's take a look at the volume, and look at that. It's just the volume is still not there. I'm telling you, if the volume doesn't kick in, the move won't hold. Am I telling you that the move can't go higher? That is not what I'm saying. The move can go higher on low volume until the shorts decide we're coming back. And once they do, if there's no other volume to support it, they're going to win and they're going to push it back down. So they got to create more short covering. They're trying. So they got to bring the shorts in to say, hey, all right, we've had enough of this. And then you see the volume kick in. So if the move moves to the upside with average or better volume, and you don't want one of those big volume spikes, you just want average or slightly above average volume, because a big volume spike means that everybody that's wanted to buy is bought, and then the move is over short term. So you don't want that, but you just want better volume here so that you have confidence that this move can continue. The next level of resistance on the Qs is there at 340, but with this doji, where do we go from here? As a reminder, because we had a wave 5 that extended more than 100%, we're only looking for a 61.8% retracement. Look where we went today. I mean, this Elliott wave Fibonacci stuff is unreal. So again, if you're live streaming, you're watching us and you haven't been around before, and perhaps you're interested in becoming a subscriber, I don't know what else I can show you that this stuff really does work. A doji dead on the 61.8% move back. That's exactly what's supposed to happen. You have a wave 5 that extends more than 100. We got all this education on Elliott wave on our website too, so you can learn all this stuff in addition to listen to me babble every week a couple times. All this education is there on our website. We have an entire education area. We're really proud of it. We put a lot of work into creating quality education, not just throwing a bunch of words on slides. We have animation and everything else to keep you interested. But when you have a wave 5 that extends more than 100%, you're supposed to get a 61.8% correction. That's exactly where we are with the doji. I don't know how it can get any more classic Elliott wave than that. Where do we go from here? Nobody knows. That's what indecision means, as we got to wait and find out where we go from here. So the IWM, that had broken above 190, as you know, and so we're looking to see how far can we go. There's another doji. So we have a doji there on the IWM as well, but it did put some distance above 190. That's pretty impressive. Did it have any volume behind it? No. So less impressive. It's impressive that it moved above it, but support has to come in at some time. It's like a rocket going up. As the rocket is going up, as it starts to lose thrust in the engine, is it still going higher? Yeah. But when it runs out of thrust, what happens? It turns and falls back down. So it can still move higher as the thrust slows down. But when it runs out, that's when it turns and tips down lower. That's what can happen in the markets, unless the next booster fires. Like they shoot the rockets and you have the first rocket engine to get up, and then they fire the boosters to get into outer space. That's what we need. We need volume to come in, kick the boosters in if we're going to go higher here in the markets and get into outer space. I don't think we have to go a whole lot higher before the shorts will say, okay, we're done. I expect them to try first. So when they come in and we start seeing some decent attempts at selling, which there haven't been any off of the lows, are those met? Is there enough volume to meet those? So is the buy the dip really the place to be right now? We'll find out when the shorts kind of dip their toes in the water and see. I'm sure they are feeling emboldened by the fact that this move is to the upside with no volume. They are not worried yet. But if the volume does kick in, they're in trouble. And they'll know that, and they will bail rather quickly, and you'll see one of those big moves to the upside, maybe like a couple day spikes that move higher. All right, so let's take a look at Bitcoin. Bitcoin moved back below the 24,000 level. It's trying. I mean, it is really trying. It's just below it, but it has to be disappointing for those that are long Bitcoin that we couldn't get that follow through day. Look, above it, no follow through, above it, no follow through. So it's going back and forth. So there's a big war going on between the longs and the shorts there, right at 24,000. We still have this really nice looking, it's not huge, so it's not foretelling a big move at a Bitcoin, but it's telling you that some sort of a, other than this back and forth stuff, is going to happen soon. So we're going to have about a 4,000 point move. Isn't that interesting? Because if it's to the upside, guess where 4,000 points brings you? Right to 28,000, which is the next level of resistance. So that's the expected move. If you break higher, if you break lower, you still got a 4,000 point move expected, which just brings you right back to support at 20,000. No harm, no foul. So, you know, I think I said this last week that by this week we'd probably know. Well, we don't. We're just getting further and further, compressing even more into the point of that triangle. One of the things we used to use as an analogy when I'm doing live seminars is with a triangle, the further you move into the point of the triangle, it's like compressing a spring. The further you compress the spring, when you release it, the more it jumps. That's what happens with a triangle. So we are right smack into the point of that. So we're going to see a decent 4,000 point move in Bitcoin. I don't know if it's up or down, but if it goes up, going to hit resistance at 28,000. If it goes down, it's going to find support at 20,000. And I know y'all make fun of me when I give both sides of the equation, but that's it. If you're picking a direction, you're guessing. We prefer not to guess. It's hard enough trading. Trading is difficult enough, even if you have a really quality system, because nothing is 100%. So there's always a percentage point you're going to be wrong. And that means that if nothing's 100%, you are wrong sometimes. But if you have a system that at least puts the percentages in your favor, it's better than a guess. And if you're looking at this right now and you're picking a direction, that's a guess, because the triangle is telling you, we don't know. That's another like indecision thing. Could go either direction. And all that ascending triangle means you're going higher, descending triangle means you're going lower is bogus. The data doesn't prove that. That's just marketing from somebody trying to sell a system. It doesn't work that way. It can go either direction, which is why when we have the triangles, we choose to go with a strangle and take care of either direction. All right, looking at EWA, you can see that we're consolidating right here in this 23 area, which makes sense because there's a lot of resistance here. We also have a wave 4 at 45%. So we could go higher here and still maintain a qualified 5-wave impulse pattern to the downside. So, you know, with all this move to the upside, all those moves so far have been wave 4 bounces, a correction from a wave 5 low. None of this has been labeled yet as a new impulse move higher. That's what you need to feel, you know, comfort that, okay, the bottom is in for sure and we're moving higher. Maybe we get that, but we just don't have it yet. And so if we do, I'll tell you that, hey, you know, that this is indeed a new impulse move to the upside. We may go take a run at new highs. We don't have that yet. Right now, we have oversold bounces. We have corrections being put in place from wave 5 lows, etc. So right now with Australia, we could easily go up and hit 24 on the EWA and still stay in a 5-wave qualified pattern. We start to get up into this 25 area, which would be the next point of resistance. If we get through 24, then you start talking about maybe this pattern becoming disqualified and we look to go test the new highs. We're not there yet, but we'll see how that plays out. Looking at Canada, you can see that pretty nice move here. In fact, that was a bit of an impressive move today, moving above this level at 35 and 36. So no follow through yet. So we got up there, traded above it, no follow through, back above it today. Can we follow through with it tomorrow? So you're seeing that tomorrow matters a lot. So when we talk with our alert subscribers on Thursday, we'll have a little more information on whether or not we got follow through from what occurred today. And then we'll have a bit more information to share. The big thing with Canada here, though, is 37. So it's going to have, you can see all these points there at 37. So I wouldn't be surprised to see it get up to 37. That's where it would become impressive if we were to get higher than that. All right. So we had a wave 5 that extended more than 100%. Where's the 61.8% level? Right here at 36. It's trying to get above it, but it's struggling, as you can see. So it's going sideways right here at the 61.8% level on the correction. So very similar there to what I was showing you before. Look at INDA on the Qs, what I was showing you at the Qs. Now look at INDA, 74%. We are about to disqualify this 5-wave pattern. Now, is India leading? Is that going to occur with the other markets too? Are these 5-wave impulse patterns to the downside all going to become disqualified? Well, could be. Nothing's guaranteed. You trade what the algorithm is showing you, and the algorithm is analyzing the data every day. Somebody asked me, what occurs when a chart relabels? It's just the way the data, the program looks at the data every single day. And if there's enough of a change in the price movement with all the data points that are in the algorithm for Elliott wave, and it relabels the charts, it relabels. But it's doing its best to tell you each and every day where things are likely to go, with nothing guaranteed. Not even Elliott wave is guaranteed. Nothing is. So you look here, we're at 44. We go much higher. There's a little bit of resistance at 45. That probably gets this pattern disqualified. So maybe it goes sideways for a bit. The thing that's impressed me the most, you can see we have a little zigzag going right here, is the fact that that vertical move barely got retraced. I would have thought that we'd have come all the way back down to 42. I think I said that that could really happen, is that we could move back down here to 42 off this vertical move. We only got as low as, what was the low there? 42.59. So it didn't quite get all the way back to 42. And then we moved back higher with that little zigzag. Pretty impressive. That was just, let's see what that correction was off the vertical move. There was just a 38% correction. You usually get more than that. You usually get at least 50% when you have a vertical move higher. Oftentimes you get a full 100% correction when it goes vertical. So to only come down to the 38.2% level, move higher, pretty impressive. I mean, you got to take your hands off to the take your hats off to the market in India right now. That's pretty darn impressive. And again, if you can get to 45, you have a whole different thing. Likely we have a completely new labeling on the charts, and we start looking for this impulse to continue higher. So one more international market, Germany, sitting here. At least we're holding in here, right? Because Germany has just been so brutal for the past year and a half or so, with just the constant moving to the downside. You get a little corrective move higher, and we keep moving lower. But we're only at a 43% wave 4 here. So we haven't had near the bounce in Germany, but at least it's holding right here around 24. But that's a major point of resistance. We've been there about a week now. Does it roll over? And do we start the wave 5 lower? Or can we break higher and try to fill these gaps? There is some room there, at least up to 25 here. There's some room with no resistance in the way, really. If it wants to move up there, then you run into a little bit of congestion here around 26, right through there. So it'd be a bit tougher to get up to 27 and fill that first downward gap. But the longer it takes that we don't run up to 25, the more you have to be concerned about the EWG rolling over, because there's just not really any resistance in the way. It should be a fairly easy move. And so far it hasn't been able to do it with a consolidation. But if it does move higher, 25 is where you find out a little bit more. So again, concern that it hasn't gotten to 25 yet without the resistance in the way leaves the opening potential for a move lower. So that's what I see there. Let's see if we can find a case study consideration to look for tonight, and then we'll open it up to questions. So taking a look here, look at the number of bullish impulse alert. 20. I don't think I've ever seen that many before. I think that is the highest I've ever seen. So when you look at that, we're going to narrow that down. This program is called Profit Source. If you're wondering what it is, to me, it's the best Elliott wave software out there, because it is programmed directly from Ralph Nelson Elliott's mathematical algorithm. There's no personal adaptation to it, which a lot of the Elliott wave software programs are. So you have to really become knowledgeable on what they switched or changed. This one is just pure Elliott wave. And so when you look over here, take a look at this. HZO is on the list. As I mentioned, we have that one. We made that adjustment on it for our subscribers. Now it's shown up as a new potential impulse to the upside. So perhaps this one really takes off from there. That would be pretty interesting. It is heavily consumer driven, and it moved to the upside today because all the retail stocks did based on Walmart's news. But what we can do is we can take these EWOs are my searches. So our alert subscribers that have Profit Source and our alert subscribers can just look at the exact same thing I'm looking at every single day and see if they find positions that they might want to do that aren't sent out as alerts for whatever reason. So now what we can do is we can put a check mark here, tick the box, as they say down under, with the bullish wave 3. So we're in an impulse and we know it's a wave 3 impulse. So we look at this and SFM and farmers market, that one shows up fairly often, amazingly so. Just not the kind of stock you would think that would show up in Elliott wave patterns very often. Well, we had a triangle, we broke out of that, so that's not going to be what we're looking for. So let's see what Keurig, everybody going to buy Keurigs and Dr. Pepper. Now that's interesting to me. I'd forgotten that there was a merger acquisition there between Keurig and Dr. Pepper. So you've got a pretty good defensive sector in there as well. And if we take all this other stuff off, pretty nice. And there's a little room before the extreme point high there on the CCI. And you've got a nice looking at least for a little bit higher. We're a tiny bit overbought here on KDP. The move looks like it wants to go to just above 42. And we're at 40. So about 20% more. You could have a pretty decent move there. Breaking above this 10-day moving average. We'll see if that can occur. But looking at the DMI, looks like perhaps we could continue and move to the upside from there. Let's see if we can find one that might look a little better, but we're going to leave that one open and see what comes up. The WERN. Pretty decent move to the upside today. The DMI looks like it might be a little bit earlier. It hasn't triggered yet. So the ADX hasn't moved above 20 yet. So that one would go on a watch list. You want to keep an eye on that. That was a pretty impressive move today. That's the kind of volume you like, where it's not a big, massive spike like one of these spikes here, where you can see that on that selling, everybody's sold there. And so you didn't go any lower. He went sideways for a while and then he went back up. And that's why you like just average to above average volume. You don't want necessarily the big spikes, but that one hasn't triggered yet. So put that on a watch list and see what happens. Danaher, let's see, Doji there a little. So it looks like some of these moves are looking a bit mature here with the ADX moving higher. We'll look at the 10-day moving average, and we're right at this level at 300, a little bit overbought, so not in a condition to go higher today, allowing the 10-day moving average to catch up. The ADX getting awfully close to 40. So again, these would be, if you were looking at KDP or Danaher, these would be quick ins and outs. This is not going to be a long-term trend. Hang around for these. You look for a small move and get out. A couple points on KDP, maybe 10 to 15 points here on Danaher. Take those and go. So again, you're not looking for some sort of a big run here out of these. And then LKQ also looks a bit mature in the move there with the ADX. It's at 30 and the positive directional indicators move back above it. This one might be a little bit better. And see what the options look like. We're not overbought. This looks like more accumulation. By the way, we're moving in that 45-degree angle. That's what I really like. It's not enough volume though for accumulation. It would be right at the average line. So that's not what's going on. Let's see what the options look like on LKQ on the NASDAQ. Spreads are too wide. Okay, so no good, no go on that one. So let's let this with a target price of 42. So KDP, I like the little aspect of some defense in there. If the market does start to struggle here a little bit. So we'll look at KDP up to 42 as our case study consideration for this week. All right, with that, Zach, I'll open it up for some questions.
Awesome. Well done, sir. Thanks for another phenomenal presentation as always. Just still can't get over looking at that Bed Bath & Beyond chart. It's going to be very interesting to watch that one.
That was a wild ride today.
Yes, indeed. All right. Well, as always, we've had tons of great questions and comments coming in through all the platforms and, of course, our Zoom audience. So we'll start out with this first one from Manuel on YouTube, who would like to look at Wolf. Sorry, WOOF.
Oh, that's not wolf, that's woof.
Wolf.
So Petco, pretty impressive. This is not really a meme stock, but it's kind of trades a little bit similar, but that's a pretty impressive break there, moving above 16. It hit 17 on the high, which is really all it has to get above. So this one's a pretty easy read. I think if you look at the volume here, again, that's perfect. You don't want these big volume spikes here. You want above average volume. I think that you want to be, my opinion, the aggressive move is to try now, but you can see we're above the 10-day moving average. We may come back and test that 16 level and let the 10-day moving average catch up. So to me, the two entry points here are on a test of 16 or a break of 17. So I think you just wait for one of those two things to happen. If either one of those happen, I think you've got a pretty good entry there. So yeah, I mean, you get above 17, there's nothing in the way. It's back to 22. I don't know how long it'd take to get there, but there's no real resistance in the way. So there probably is going to be some shorts that try to hold the line there at 17. And with it being a touch over bought right now, I don't think there's much threat of it running through there, but you know, that's the key. So if it comes back down, test 16, lets the 10-day moving average catch up, then you could be aggressive and try to go ahead and enter now and see if it breaks 17. Or if you wanted to be more conservative, let it break 17 first, because then you're in clean air without much resistance, and you're probably all the way back up here. And I do like the little slight defensive lean on a stock like Petco. We talk about the defensive sectors, the sin stocks, alcohol, tobacco, gambling, etc. But statistics have shown that even if the economy weakens, even if we go into a deeper recession that's programmed, people are going to take care of their pets. So, you know, they're members of the family. So I like that aspect of that one as well. So really cool chart. Thanks for asking about that one.
Yes, I agree. All right, so this next question here, I actually have 4 questions all within the same chart on the SPY, 3 from our Zoom audience and 1 from YouTube. So I'll give you one by one. Some of it you've already kind of answered, so just a quick overview on it I think would be good. First one here from George: do you think filling the gap at 375 on the SPY has to be filled soon, or do we just move higher? Also the August gap.
Yeah, I think 375 could be a little bit further away. I really thought we would come down and fill this August gap before moving higher. I feel like if the shorts are going to try right now, this is their opportunity right here at this level. We've got resistance at 440. We're at a 61.8% fib level. if the shorts are going to show themselves, I think it's going to be right here. And moving back down to fill that gap, breaking back below 420 would send, through the markets. We're back below 420. We've broken down through support, and the markets could still turn and go higher from there. So that one, I feel like that one gets filled in the not too distant future, even if the market ends up going higher. The research says 94% of gaps get filled. All gaps don't get filled. It's not 100%, but at some point in time, that one will get filled. Is it later in the year when, the Federal Reserve actually does start withdrawing liquidity? Is there war breaking out between China and Taiwan? There's a lot of things that could trigger this. But so far, with the Federal Reserve leaving all this liquidity in, they've allowed this move to happen. Now, whether that was done on purpose or just being cautious because they didn't want to raise rates and withdraw liquidity at the same time, I don't know. We're not in that room. But remember, the Federal Reserve is an independent business. They have nothing to do with the government. They do their own thing. So we'll see. But that, it's a valid question. So my long-winded answer is I do feel like this gap gets filled fairly soon, but we could hold there and move back higher if the Federal Reserve is not going to start withdrawing liquidity. That would be an immediate effect. So if you're wondering, interest rates take about 6 months to move through the economy, but a liquidity withdrawal has a far more immediate effect, which could be why they're not doing it. Having an immediate effect now on the balance sheet reduction, and then down the road getting hit again, that would be the second whammy of the double whammy of the interest rates starting to filter through the economy. That's giving them a lot of credit, but it's either that or they're doing it politically. Who knows what the answer is? But anyway, I'll move on because I know there's more questions.
Yeah, there are more questions. There's a few more on the SPY, which I feel like you've covered in pretty great detail now. So we might encourage those questions to come through again on Thursday if there's any more analysis that's requested. So next up, we'll say here from Chris from YouTube would like to look at ENPH, sorry.
Yeah, I figured that one was going to come up again. You can see that had that really nice move, and then it's been going through consolidation, and that's pretty impressive too, because there's another vertical move there, 2 gaps, and we've come back to the 10-day moving average, so we allowed the 10-day moving average to catch up, and it's just gone sideways. And if you look at the DMI, you would see, all right, now we're in danger of falling back down, and I think we are. To come back and create this wave 4. The ADX is so high up there, 45, but look what's happened to the positive directional indicator. So what that's telling you is those that wanted to buy in have done so, and now we're starting to get a little tick up in the negative directional indicator. So could we drift a little higher from here? We could, because the longs are still slightly in control, but they're weakening significantly, so I'd be careful. So if I was long this, I would be careful of a drop and go ahead and take gains if you're able to catch that move there. If you're looking to go long from here, I think that's got some risk to it based on what we're seeing here with the DMI and the fact that you've got gaps to fill there. And you can see on the move lower today, there was above average volume. So it seems like some of the people that got caught here with this gap are looking to close those gaps, and that would include market makers to come back and get their money back on those gaps. Because I'd be careful on that one right now. If it moves higher, I'd be quick to take gains. If you're in it, if you're long, be really careful there. Break below 280, and that's danger, Will Robinson. So if you wanted to stay long above 280, I could certainly see that. But below 280, I think we're probably coming down to fill those gaps and create that wave 4.
Right, taking the gain, but proceeding with caution.
Yeah.
So there's been some chat here between Douglas and Will on YouTube about UNG. Douglas says, looks like an ABC correction.
Yeah, we've been trying to find another entry for another butterfly here, but it's not really doing it because it's given us a directional pattern here, not a sideways type pattern. So very clearly, we have a zigzag right there. So you can see that 61.8 is the move there, and so around 34 or so. And if it can get above that, then it goes up to nearly 40. So, that's not too much further. There's only a couple points further, but yeah, that's an upward zigzag pattern. And so when we see that, we want to look at the DMI. And I find this fascinating. I mean, I'm amazed by this, that we're showing that kind of strength out of the DMI. So you've got a zigzag pattern with a confirming DMI. It does look like UNG wants to go higher. So we're right at resistance. If it breaks above that, it probably goes and hits that wave 5 target and doesn't just stop, at 34, 35. We probably go all the way up near 40 based on that DMI setting up about as nice as you could look for one. And the break above 30 today and yesterday are key. So we talk about follow through. So we had a break above it here on the 11th, no follow through. Break above it yesterday, follow through today. A tiny bit overbought. Maybe we come back down and test 30. You would actually want that because that'd be a great entry to go long, but it may not do that. So yeah, I like UNG to go higher. So yeah, no butterfly opportunity, but probably a pretty good directional move to the upside there.
Absolutely. And so I see we're a minute after the hour. As always, I'm happy to stay on as long as you are. So you tell me how many more to pass through and I'll be happy to do so.
Yeah, let's do a couple more. We haven't had that many of them, so let's do a couple more.
Yeah, no worries. So interesting question here from Jeff on Zoom. What upcoming catalyst might push the market to retest the June lows?
China invading Taiwan, the COVID getting a little more severe. The people haven't been really talking about it too much, but you're seeing a lot of masks show up again. I think those two are more black swan type things, but I think the big one is if the Federal Reserve does what they said they're going to do, start reducing their balance sheet, withdrawing liquidity, and then if they're just letting bonds fall off the balance sheet, doesn't withdraw liquidity. So if they start withdrawing it, it can be very difficult for the market to move to the upside. So if they start doing that now, and then those interest rates start to hit, we may see it, as I said, in this next quarterly earnings. It might be 2 quarters from now, which is 6 months, of what, call it 4.5, 5 months away now. And we could start to see a move lower there. So you notice that those that are getting past November, and that's why there's all these conspiracies of, the Federal Reserve is doing this because of the midterm elections coming up. I'm just saying it aids the conspiracy theories. I'm not saying that's why they're doing it. I don't know why they're doing it. That's, common sense would tell you it's one of the two scenarios. So we'll see from there. But there are catalysts to move it back down. But don't underestimate the importance of liquidity in the markets. It's what's driving this move higher now. It's what could turn the markets lower. And pay attention to it. As soon as the numbers come out for July, we'll share those with you on what they're doing, because I think that's a big key to the markets moving forward to where we go.
Yeah, absolutely. Well, we'll surely have to find out and see what the Fed decides to end up doing and that impact it'll have. So another question here from Will on YouTube. Are there any U.S. stocks that will benefit from the Inflation Reduction Act, a U.S. lithium miner?
Well, looking at some of the lithium-based stocks, maybe an ETF or something along those lines might be a place to look. They just signed it, so there's a lot of volatility right now. Might wait a little bit, let that calm down, and then perhaps start to take a look there. Specifically, I don't know about, I don't know. I guess I'm questioning how effective the legislation is going to be. That's what my pause is on that. So I don't really feel comfortable coming out with what may do well under that scenario. I feel like what's going to control the market comes from different areas than that legislation. I might be wrong. I'm wrong times. So we all are. So I could be wrong on that scenario, but we'll see. Keep an eye on it. Ask again in the coming weeks, and we'll see how that's playing out. But thanks everybody for your attention this evening. As always, as you know, sign off the same way every time. Time's the most valuable asset we all have, and we appreciate very much when you devote some of your valuable time to us, and we will always do our best to make that an informative and educational use of your time. Thanks so much. Have a great rest of your week. Look forward to talking again soon. Take care.